So let's now talk briefly about fiscal and monetary policy, which are the two major arms of macroeconomic policy. Fiscal policy, which is run by the Treasury, is government spending and taxation. Monetary policy, which is run by the central bank, involves typically adjusting interest rates up and down with the view that higher interest rates will stifle spending and lower interest rates will stimulate spending. And also in more recent period, we've had what's called non-standard monetary policy like quantitative easing. Now in this neoliberal period over the last 3 or so decades, we've had a bias within macroeconomics towards the use of monetary policy as the primary adjustment tool for total spending in the economy, allegedly run by independent central banks which are outside the political influence of government. And fiscal policy has been biased towards austerity. And the presumption was that that would give much better policy settings because the independent central bank, inverted commas, would be resistant to political flavours and only implement policy that was appropriate to the times. But what we've learned is that that bias has failed. First of all, monetary policy delivers ambiguous effects. Take an interest rate rise that helps creditors, people who have lent money, but it punishes debtors. We don't know what the balance of those distributional effects are. We also don't really know whether interest rate rises stifle inflationary pressures in the economy or actually add to them because they push up the costs of business. It's likely to be the latter. And we think of monetary policy as a very blunt instrument. It relies on changing behaviour among borrowers and creditors, which then might or might not seep through to total spending. And this is why in MMT we prefer fiscal policy to be the primary macroeconomic policy tool to adjust spending in the economy when it's necessary, because it's direct. If the government spends an additional dollar into the economy, that goes straight into the spending stream, or if they withdraw that, goes directly into the economy. It can be targeted spatially by demographic cohort, and it's much more immediate in its impact. And this reliance on monetary policy has pushed the monetary parameters to extreme limits, which are now starting to undermine the prosperity of the economy. An example is quantitative easing. What is it? The central bank buys government bonds off the private banks and gives the private bank reserves. Now, the logic was that the private banks weren't spending enough, and this started in the global financial crisis basically. Private banks weren't loaning enough because they didn't have enough money. And this goes back to the mainstream idea that banks only lend out their reserves. Now, of course, as we learnt when we considered the crowding out fallacy, banks don't lend out reserves. They create loans which create deposits with strokes of pens. And so the whole reason the banks weren't making loans during the GFC and subsequently is because there weren't enough creditworthy borrowers to come into the banks to borrow money. So QE wasn't a solution to that problem. And the only way QE can work is if it lowers interest rates in the economy so much that investors will borrow more, but they won't borrow more because even if interest rates are low, if they can't sell the stuff that they would make from the new capital equipment. And so QE basically failed in its purpose, and it failed to push inflation rates up, which has been the major objective of central banks. So when we talk about fiscal policy, we can't leave out the discussion of public debt and the issuing of bonds. So the government issues bonds to the non-government sector, and we've been led to believe that those bonds being issued provide the funds that governments use then to run spending greater than their taxation revenue. In other words, funding the government deficits. But of course, as we've learned already, governments who issue their own currency face no financial constraint. And so the question then is, well, why would they issue debt? Now, in modern monetary theory, we believe that a government that's not financially constrained has no reason to issue debt. And so then the question is, well, what does the debt do? Now, students learn in mainstream theories that the issuing of debt reduces the inflation risk of the government deficits. The problem with that analysis is that it's wrong, that there's no reduction in risk because the inflation risk is in the government spending, how that interacts with the productive capacity of the economy. And all the debt issuing does is allow the non-government sector to shuffle its wealth into preferred assets or non-preferred assets, their financial assets. And in MMT, we characterise the issuance of debt as corporate welfare because what it basically offers to the non-government sector is a risk-free asset which it can park its funds when it's uncertain about returns and viability of other financial assets. And so it's really not the purpose of fiscal policy to be providing that sort of security to speculators in financial markets. There's no other reason to issue debt, and so MMT extrapolation is for the government not to issue any debt. It's not necessary.